the financial frontier. I'm your host, Patrick Camuso, where I'm bringing you the latest regulatory updates related to Web3 and digital assets for tax, accounting, and finance professionals. There's a lot to get into today. First off, we've obviously seen the SEC approve the Bitcoin spot ETF. This is huge news industry wide. We're seeing people extremely pleased by this as expected. Of course, I'm no exception to this. So I'm very happy to see this. I'm not going to belabor this point too much just because I know it's going to be sort of the key thing that's being spoken about industry wide, but I did want to hit on that and just sort of highlight that I'm happy to see that as well. There's a lot that I want to get into on the tax and regulatory side. So let me share my screen here. And we'll start to get right into things. So first off, I want to encourage everyone to sign up for our event, How to Avoid Common Digital Asset Tax and Accounting Mistakes. This is going to be on actually tomorrow, January 12th at 9 a.m. We have about 122 people, a little over that, signed up. So I'm going to go over a lot of the mistakes that I see made at the investor level related to digital assets. These are mistakes that I find myself correcting and unwinding on a weekly or daily basis at Camuso CPA. So there's going to be a lot of interesting points that I go over here that I basically, like I said, I see every week. They're extremely common, they're easily avoidable, but most people just overlook them. So I'm looking forward to this. And then on February 8th, 2024, from starting at 9 a.m., we're hosting tax traps to avoid for Web3. So here we're going to go over a lot of the issues related to Web3 businesses setting up their accounting systems, setting up their tax systems, and some of the pitfalls that I'm consistently seeing businesses fall into just related to taxes, accounting, and crypto in general. So I'm looking forward to this as well. Be sure to sign up for this. You can go ahead over to LinkedIn. The go-to-webinar link is there. Next up, if you go to camusocpa.com under our resources, you can sign up for the Digital Asset Digest, which is going to more or less be a newsletter format of this podcast with more details, more information, more relevant updates delivered straight to your inbox. And lastly, the last thing I want to point out is this video podcast that we've been doing for about a year now on LinkedIn. We are now posting to many more platforms. We currently post on LinkedIn, YouTube, and Twitter. We've expanded to podcast platforms as well, including SoundCloud and Spotify. So check us out there. Check out our website at thefinancialfrontier.com. You're going to be seeing a lot more from me this year related to this podcast and just covering topics related to Web3 and digital asset tax and accounting. I'm going to be expanding this into interviewing more professionals in the space to deliver more value to you as an audience member. So let's get into some of the headlines. Let's get into some of the things that I'm seeing. So again, one of the big things here going into the 2024 year is going to be tax enforcement, data collection by the IRS, and just overall tax enforcement heating up when it comes to digital assets and the IRS's focus on digital assets. So we see this headline here: IRS surge in crypto tax evasion cases after the Binance probe. So the IRS criminal investigation chief, Jim Lee, said that crypto tax evasion cases have jumped 10% 3 years ago to around 50% of the digital asset probes now. So that is a huge shift from 10% to over half of the crypto tax evasion cases, or half of the criminal cases related to crypto are now crypto tax evasion. So there's this big shift from money laundering to people actually not paying their taxes. So This is led by the Binance probe, they're saying, which concluded in December with a guilty plea of 4.3 billion settlement over AML and sanction brief. So we actually covered that Binance settlement on the last episode of the Financial Frontier. So as I said, yeah, this is overtaking money laundering. So we're going to see a big shift this year, likely in the headlines as well, and a lot of these cases starting to get reported. And hopefully, as a result of that, we'll start to see people take their taxes more seriously. So similarly, on that note, this was something that I was reading from Deloitte on preparing for IRS exams for crypto transactions. And within this, they were actually pointing out some things that they're seeing within their practice related to areas of focus during an audit related to the IRS. And I thought this was interesting because they touched on a couple things that I focus on at Camuso CPA and that I've also been mentioning a lot on the Financial Frontier. And that is related to the audit risk associated with your accounting method selection. And let me try to scroll down and find this here, because this is pretty long, but it's worth the read. It was pretty good. Let's see here. How can we find this? So the review can take a deep dive into methods of accounting, specific identification of digital assets tracking, use to first in, first out, etc. So that is the first thing that they're really listing here that a review is going to focus on is your accounting method selection. I've always thought the lowest hanging fruit from the IRS from a tax enforcement standpoint would be people that are significantly underreporting and are in non-compliance. We've seen that be the IRS's main focus, and the ways that they try to address that is via information collection and then tax notices. So, the John Doe audits basically, and then them sending out tax notices. And then the second level of lowest hanging fruit, I believe, are people that are applying incorrect tax treatments to their digital asset transactions. And there's many, and many of them are listed here, spec ID, character, capital versus ordinary, holding period, treatment of stake and rewards. 83B elections, we see a lot of those, informational reporting, sourcing of revenue and gains. But the big one I think is spec ID, because there is a large percentage of people in the industry that are applying spec ID, not really even applying spec ID, they're applying an accounting method other than FIFO, usually HIFO or LIFO or something like that, across their whole entire portfolio. They're not considering any considerations on an asset by asset level. And many times what I see when firms come to Camuso CPA is that the tax reporting and the audit trails related to their transactions aren't necessarily congruent with their actual on-chain activity and their activity that's taking place within exchanges. So if you're just basically blanket selecting HIFO on your favorite crypto accounting software and filing that with the IRS and you go under review, you are going to have to substantiate that tax position. And they're going to want to see an audit trail. And if you say that, you took a Bitcoin that was purchased on Coinbase and you sold it on Binance because that was your highest in first out calculation, that should be substantiated with an audit trail and an actual transfer of those assets from Coinbase to Binance. So what I see a lot is that people are basically cherry picking an accounting method after the fact. They're not managing their assets, how they're reporting them to the IRS. And this seems like it's going to be a big issue that comes to the head. And it seems like Deloitte is actually citing that here with some of their experiences with some reviews and audits, stating that, the accounting method for specific identification versus first in, first out is going to be one of the things that gets scrutinized. So they're calling this the silent investigations. So they've been gathering information, going through social media and other channels. So yeah, if they're gathering your information and you're out here posting online about it, this is another thing I always harp on. They are watching you post online. So I thought that this was interesting because the spec ID was specifically cited here, and it was something that I expect the IRS to focus on, and now we're starting to get confirmation of that. So I think non-reporters are at the biggest risk because they're not in compliance, and the IRS is more than aware of that. But then the next biggest group of people that really need to be considering what the impact of an audit will be are people that are choosing the wrong accounting method or taking the wrong tax positions. Outside of choosing the wrong accounting method, the next thing I think is probably the biggest issue is taking the wrong tax positions. Usually and it gets sort of nuanced. It can be related to someone trying to say that their staking activity is a business, or that their staking income shouldn't be claimed as income, or just taking some of these more aggressive, outrageous positions that likely aren't going to stand up to an audit. So this report overall is great. Like I said, it is a little lengthy, but there's a lot more information in it. So, I encourage people to check this out. So now this is probably something that you've been seeing go around in the headlines now for the past week or so, maybe a little bit longer. I know that I have been having questions just pour into my inbox from clients that, are seeing these headlines, reaching out to me, asking me questions about it. And I think that's great because this is a very important reporting requirement that if you're involved in crypto, you need to be aware of. So the IRS rules require reporting data from 10K in crypto transactions in 2024. So basically, if you are functioning as a trader or business and you receive 10K or more as a payment in USD equivalents of a digital asset, there's going to be informational reporting requirements that you have to file with the IRS within a certain time span. And if you don't take those steps, you are going to face significant tax penalties as a result. So what information are you going to have to give the IRS? You're basically going to have to give the IRS KYC information on the person that paid you, their name, address, social, and other basic information like that. So the reason that people are unhappy about this is two reasons. It's just another step of data and information collection and surveillance from the IRS that industry-wide people are unhappy with. But also it's another tax consideration and regulatory requirement for acting in this space that can come with significant penalties for people who are not in compliance. And all it takes is you don't report it and you're not in compliance. So this is something that, if you are acting as a trader or a business, and that can mean that you have an actual business set up, or you're an individual but your activities rise to the level of a trader business, you may have filing requirements with this. It's something you want to be proactive with. It's something you want to speak to a CPA with now. Understand the reporting requirements. Make sure that you're collecting the right information to meet the reporting requirements, so you're in a position when, if you have one of these payments over the threshold that you receive that you do have to file, you have the information and you're prepared to file in a timely manner. So one thing I will stress here on this is that, again, this is only for trader businesses. So a lot of people that reached out to me, there were a lot of trader businesses that reached out to me, but also a lot of individual investors that were worried about this. If you're strictly investing and you're not a trader business, it's unlikely that this is going to apply to you. But you want to definitely make sure with the CPA that the level of activities that you're doing on chain don't rise to the level of a trader or business. So you're seeing here, so if a miner receives a block reward, so yes, a miner would be a trader business, but it's that is an interesting point that's raised here by Coin Center. Is the miner going to have reporting requirements from the blockchain that they get their rewards from? That's something that's going to be unclear. A couple other things are unclear as well: LP contributions, distributions, foreign payments. So these are things that we're going to get some more information on. So this is a huge requirement again, and you want to make sure that you're getting into compliance with this. This went into effect January 1st, 2024. Although over the next week or two, I am expecting to see more information and regulatory guidance related to the reporting requirements related to Form 8300 and some of the other open questions related to this. So then we have this article out of Thomson Reuters, Income and Business Activity Taxation of Crypto Assets, Multi-Nexus and Apportionment Concerns. So this is one of the next big issues that we're going to see in 2024 that right now I don't think a lot of people are focused on, but that is going to be state tax issues related to cryptocurrency. And this is going to take many forms that are listed in this article. As you see, this article is a 17-minute read, so I'm not going to be able to get through all of it here, but I do think that this is a great article. I encourage people to check this article out. What they're going over here is a couple different things. Number one, apportionments to the right states related to capital gains and income from digital assets. That's going to be a very big issue going forward, as well as sales taxes on digital assets and NFTs and the sourcing rules related to that. So right now, everyone is looking towards the IRS and the federal tax requirements related to crypto. We're focused on Form 8300, the proposed broker regs, NFT taxation, how is staking tax. These have been some of the big topics we've seen over the last 6 months from the federal tax standpoint, but we are going to see a lot of these state issues come to a head. And in addition to a lot of the federal issues that we've been focusing on, the state issues have been a focus of myself and Camuso CPA for some time now, because we've seen this problem coming for a while, and we've been anticipating it and preparing our clients for it. So this is something that you want to take the same approach. If you're a tax professional, a CPA, a CFO, you want to start making your clients aware of this. And if you're a Web3 CEO or digital asset investor, you want to make sure that you're considering this within your tax plan, within your compliance plan, and implementing any necessary changes within your accounting system. So lastly, something that I just want to hit on here is that we are in January and everyone's going to be receiving their tax reporting here in a matter of the next days and weeks. And it is time to start thinking about the tax season. And if you need accounting or tax assistance, of course, you can reach out to my team at Camuso CPA. We can schedule a consultation. I can talk to you one-on-one about your tax and accounting needs related to your on-chain activity and your overall activity, and we can see how we can assist you. But what are some of the things that you should be gathering right now? A history of all of your transactions across all blockchains. So that means for non-custodial wallets, you want to list out all of your public wallet addresses. You want to list out all associated blockchains. If you haven't been doing it throughout the year, you want to go to all centralized exchanges and you want to download your source transaction histories from these exchanges to save this in your permanent records. Another thing you want to do, and what you should have done at year end, if you haven't, go do this now. Go and record the ending balances as of year end for every asset that you own, so we can use this for due diligence purposes when we're finalizing your accounting and we're comparing our calculated ending holdings to your actual ending holdings. Taking these preliminary steps of getting this transaction data will save you some legwork if you sit down and you talk with me at my firm at Camuso CPA, because usually our first step is going to be reviewing this data in order to assess your overall needs and scope and price the engagement. So that would be my recommendation, is get all of your transaction data in order. And when you go to speak with your CPA, you're going to be one step ahead and you're not going to be scrambling around as much. So overall, it's better to be proactive, to get started earlier rather than later with this process, because especially when it comes to digital asset accounting, there is an open-ended nature to the overall reconciliation and due diligence process. And sometimes these engagements can take a little bit longer than you originally expect, especially if you're a digital asset investor that has to clean up multiple years of missed accounting, or if you're a Web3 business that has to come and get an accounting system established and possibly clean up months or a year or two worth of back accounting. So that is my advice. Be proactive, speak with your CPA early, get started on tax season early, and make sure that you're getting all of your transaction records and all of your information in order up front. The key with crypto and the key with taxes is to be proactive. And if you're looking for more information on this, if you go to camusacpa.com, we have a blog out right now, the 2024 Comprehensive Beginner's Guide to Crypto Tax and Accounting. So we go over a lot of tips here related to some of the considerations that you need to take into account related to 1099 matching, John Doe audits, FIFO versus specific identification, audit trail. So, there's a lot of information here. I encourage you to check that out. But overall, make sure that you're taking this tax season seriously, because I'll tell you right now, the IRS is taking this tax season seriously when it comes to digital assets. Thank you for taking the time to watch The Financial Frontier. I'm your host, Patrick Camusa, signing off.